Welcome to This Explainer. Today, we're diving into a genuinely fascinating financial mystery. I want you to picture looking out at a completely calm, glassy ocean. But just a few inches below the surface, there's a massive, violent riptide churning everything up. Well, that's exactly what happened in the Indian stock market on May 13, 2026. If you just glance at the headlines, it looked like a totally flat, boring day where absolutely nothing happened. But once we peel back the layers and actually look at the data from this specific trading session, we uncover this incredibly dramatic story. We're talking extreme volatility, aggressive capital rotation, and a hidden tug-of-war between some massive economic forces. Let's get into it. So, the Nifty 50 benchmark index closed the day with a microscopic gain of barely over 0.14%. For any casual observer, that just suggests a sleepy, sideways day of consolidation. You'd probably assume traders just took the day off, or the market was just treading water, right? But as you'll see in a second, relying on that single surface-level closing number is incredibly deceptive. Okay, here's where the illusion breaks. Because while the closing gain was practically zero, the intraday movement, that violent swing from the lowest low to the highest high during trading hours, was a staggering 320.4 points. That is massive. That kind of fluctuation signals intensely high levels of speculation and mixed sentiment. Buyers and sellers were locked in this brutal high-stakes combat all day long. The fact that they fought so hard over 320 points, only to basically end up exactly where they started, that tells us we are absolutely not looking at a sleepy market. We're looking at a market in a state of high-energy indecision.
And the sheer amount of money fueling this battle? Absolutely explosive. We're talking over 138,000 crores in traded value across 42 million trades. This wasn't just retail investors playing around. Huge, massive blocks of institutional liquidity were changing hands at lightning speed. Which brings us to the central mystery of our explainer today. If all this big money was moving so aggressively, but the overall market barely budged, where exactly was all that capital going?
Section 1. A Tale of Two Markets.
And this brilliantly illustrates the answer. Look at this massive split. On one side, you have the Nifty Metal Index spiking, gaining nearly 410 points. It was the undisputed heavyweight champion of the day. But on the flip side, the Nifty IT Index was completely bleeding out, dropping over 318 points. This right here is why the benchmark index looked completely flat. The broader market essentially acted like a giant shock absorber, using the massive strength of the commodity and energy sectors to perfectly offset the severe bleeding in technology. So what we're actually witnessing is a highly deliberate selective capital rotation. Big money is actively flowing out of your traditional growth and defensive safe havens like IT and banking. Investors are clearly spooked by global macro slowdown fears and interest rate concerns. So instead, they are aggressively pivoting. They're pouring that capital straight into cyclical assets, metals, energy, infrastructure. They're betting heavily on sectors that will ride a robust global economic upcycle and a massive boom in domestic physical development. You can see this insatiable appetite for physical assets by just looking at the day's top momentum stocks. We're not talking about modest, safe little gains here. We are seeing massive, double-digit explosions in heavy industries. Steel Authority of India, SAIL, rocketing up over 14%. Textrail up nearly 14%. Jingle Drilling up over 12%. These aren't software companies building apps. These are the companies that physically forge the steel, lay the railway tracks, and extract the resources from the earth. The capital is aggressively chasing a very specific heavy industry boom.
Section 2. Following the Capex Money Trail.
The data is essentially screaming that institutional investors are betting the farm on a capex cycle revival. They're looking at massive government infrastructure pushes, teaming up with renewed private investment, and they believe this is going to be the engine for economic growth for quarters to come. So they are actively front-running this anticipated boom by buying up the heavy lifters, the actual companies that are going to physically build out this new infrastructure.
Now, what's really interesting about this list of the Nifty 50's top gainers isn't just who's on it, but who's missing. Do you see any banks here? Any IT service giants? Nope, not a single one. What you see instead is a totally unified bet on physical reality. You've got your raw metals with Tata Steel and Hindalco. You have infrastructure and logistics giants like Adani Enterprises and Adani Ports. And then you have domestic consumption tied to the end of the housing cycle with Asian Paints.
These aren't just random stocks having a good day. They form a perfect synergistic supply chain for a nationwide construction boom. It's like a giant puzzle. Step 1. A major infrastructure project gets the green light, so Tata and Hindalco immediately spin up to supply the raw steel and aluminum. Step 2. All those heavy materials need to be moved, which perfectly feeds the logistics networks handled by Adani Ports. Step 3. Once the buildings and homes actually go up, consumer spending kicks in, and companies like Asian Paints are brought in for the finishing touches. Investors aren't just buying stocks, they are literally buying the entire life cycle of a construction boom.
Section 3. Warning signs and vulnerabilities. But of course, no market rotation is perfect, and the weakness in these specific sectors acts as a massive flashing warning sign. Look at automakers like Mahindra & Mahindra and Eicher Motors sliding around 2%. Look at an IT giant like Infosys down 1.5%. This tells us there's a heavy dose of institutional caution and likely some aggressive profit-taking. Autos and manufacturing are incredibly sensitive to interest rates and the health of the global supply chain. So while investors absolutely love this government-backed infrastructure narrative, they are still deeply, deeply worried about immediate consumer spending power and shrinking global tech budgets.
In that underlying anxiety, it is perfectly captured by this single number. The India VIX, the market's ultimate fear gauge, actually ticked up slightly on this exact same day. Think about that. A rising VIX on a day where the market closes in the green is a fascinating anomaly. It means that despite the flat close and those booming metal stocks, market participants are actively hedging their bets. They are bracing for turbulence. There is a very real, creeping tension humming just beneath the surface.
And where's that tension coming from? Macroeconomic headwinds. This quote pretty much hits the nail on the head. Domestic optimism might be sky high right now, but the broader market is terrified of currency vulnerability. A weak rupee, constantly colliding with fluctuating global commodity cycles, is the elephant in the room. It's a massive external risk. If the currency weakens too much, importing essential goods becomes painfully expensive. That could quickly wipe out corporate earnings and shatter the very consumer confidence needed to keep this whole domestic rally from collapsing.
Section 4. The Investor Playbook. So what does this all mean for you? The crucial takeaway here is that broad, lazy, index-level investing probably isn't going to cut it in a market this fragmented. You need a highly selective playbook. First, follow that CapEx trail. Zero in on the sectors riding the government's infrastructure wave, like cement, steel, and rail. Second, you might want to build a commodity hedge against persistent inflation, since physical resources are clearly the big winners right now. Third, avoid knee-jerk panic selling. Just because banks and IT took a hit today doesn't mean they're fundamentally broken, they're just sitting this cycle out. And finally, you have to obsessively monitor domestic earnings to see if they can genuinely outpace the drag of a vulnerable global currency.
Which brings us right to the ultimate cliffhanger. We've seen the massive, aggressive rotation into physical assets, and we've felt that creeping fear reflected in the volatility index. The market is currently trying to pull off this incredibly delicate balancing act, leaning heavily on domestic infrastructure to offset global macro weakness. But as we've completely uncovered today, that calm surface of a flat trading day was nothing but a mirage. So, will this cyclical, domestically focused rotation prove strong enough to launch the next major bull run, or will global headwinds and a fragile currency ultimately shatter the illusion? That is the billion-dollar question every investor has to answer before making their next move. Thank you so much for joining me on this explainer. Keep learning, keep questioning the surface data, and I'll see you next time.